Imagine this: one unexpected car repair, one sudden medical bill, one phone call from a family member in need. For most of us, that single event is all it takes to send our finances spiraling out of control. It sounds dramatic, but the reality is that millions of people are just one paycheck away from serious debt. That's why today, we're talking about something that isn't just a nice to have anymore. It's an absolute necessity. We're talking about your financial bodyguard, the emergency fund. So, what exactly is an emergency fund? Let's clear up some confusion. It's not your vacation fund, it's not your new gadget fund, and it's definitely not your "I had a bad day, so I'm going shopping" fund. An emergency fund is a specific stash of cash set aside for one purpose and one purpose only: to cover true, unforeseen emergencies. Think of it as your personal financial safety net, ready to catch you when life throws you a curveball. It's the buffer between you and financial disaster, giving you stability when everything else feels shaky. Now you might be thinking, I've heard this before. But here's why an emergency fund matters more today than ever. We're living in a time of incredible economic uncertainty. The cost of living is climbing relentlessly. Gas, groceries, rent, everything costs more. Inflation is eating away at our purchasing power, meaning every dollar we earn doesn't stretch as far as it used to. On top of that, job security isn't what it once was. Industries are changing, companies are downsizing, and freelance or gig work means income can be unpredictable. And then there are the big life events that nobody can predict. A medical crisis, urgent home repairs like a burst pipe, or a sudden need to travel to support family. Without a cushion, these events can be financially crippling. Let's talk about the real cost of not having an emergency fund. When a crisis hits and you have no cash reserves, what happens? You're forced to turn to high-interest credit cards, plunging you into a cycle of debt that's incredibly hard to escape. Or you might have to take out a personal loan with unfavorable terms. The financial stress is immense, leading to anxiety, sleepless nights, and rushed poor decisions that only make the situation worse. You might be forced to borrow money from friends or family, which can strain relationships, or even worse, sell your assets, like your car or other valuables, at a huge loss just to get cash quickly. An emergency fund protects you from all of this. It gives you the power to handle a crisis without sacrificing your long-term financial health. So, how much do you actually need? This is the million-dollar question, but the answer is simpler than you think. Don't get overwhelmed by the big numbers. The first most important step is to start. Aim for a beginner's mini fund of $500 or even $1,000. This initial amount is enough to cover most common small emergencies, like a flat tire or a minor medical copay, and it stops you from reaching for that credit card. Once you hit that goal, the long-term target is to save 3 to 6 months' worth of essential living expenses. That means calculating what you absolutely need to spend each month on housing, utilities, food, and transportation, and then multiplying that by 3 to 6. If your income is very stable, 3 months might be enough. If you're a freelancer or have a less predictable income, aiming for 6 months or more will give you greater peace of mind. Building an emergency fund might sound daunting, but it's all about creating a simple, repeatable system. The most effective strategy is to pay yourself first. This means the very first thing you do when you get paid, before you pay bills, buy groceries, or spend on anything else, is to move a set amount of money into your emergency fund. The easiest way to do this is to automate it. Set up an automatic transfer from your checking account to your savings account for the day after you get paid. It could be $20, $50, $100, whatever you can afford. The amount isn't as important as the consistency. Starting small is better than not starting at all. Over time, those small, consistent contributions will grow into a substantial safety net. Where should you keep this money? The key here is balance. You need it to be easily accessible, but also separate from your daily spending money. The best place for an emergency fund is a high-yield savings account. It's safe, it's liquid, meaning you can get the cash quickly when you need it. And a high-yield account will even earn you a little bit of interest. The crucial part is that this account should be separate from your primary checking account. If you see the money every time you log into your bank app, you'll be tempted to spend it. By keeping it separate, you create a psychological barrier that helps you reserve it for true emergencies only. Remember, this is your insurance policy, not an investment. It shouldn't be in stocks, crypto, or anything else that could lose value right when you need it most. As you build your fund, there are a few common mistakes to avoid. The biggest one is dipping into your emergency fund for non-emergencies. A weekend sale on your favorite brand is not an emergency. A last-minute concert ticket is not an emergency. You have to be disciplined. Another major mistake is getting too clever with where you keep the money. People hear investing and think they can make their emergency fund grow faster. But investing involves risk. The stock market could crash right when your car breaks down, and suddenly your fund is worth half of what it was. Keep it safe and liquid. Finally, the most common mistake of all is waiting for the perfect time to start. People say, "I'll start saving when I get a raise," or when my debt is paid off. The perfect time is a myth. The perfect time is right now with whatever you have. Let's think about some real-life scenarios where an emergency fund is a true lifesaver. Imagine you, or a loved one, has a sudden medical issue. An emergency fund means you can cover the deductible and co-pays without a second thought, focusing on recovery instead of the bills. Or picture this. You show up to work one day and find out your department has been eliminated. It's a terrifying moment, but with 3 to 6 months of expenses saved, you have breathing room. You have time to update your resume, network, and find the right next job, not just the first one that comes along because you're desperate. Or what about a call from your landlord saying a pipe burst and your apartment is flooded? An emergency fund can cover a temporary hotel stay and the replacement of essential items while you sort things out with insurance. In every one of these situations, money buys you something far more valuable than just stuff. It buys you time, options, and peace of mind. Ultimately, building an emergency fund is one of the most powerful acts of self-care you can perform. It's about taking control of your future. It's not about being rich, it's about being prepared. It's about giving your future self the gift of security in an uncertain world. The journey of 1,000 miles begins with a single step, and your journey to financial resilience begins with that first dollar you set aside. So please, don't put it off another day. Open that savings account, set up that automatic transfer. Start today. Your future self will thank you for it. So, you've set a goal for your emergency fund? Maybe it's that initial $1,000. Or you're aiming for the full 3 to 6 months of expenses. The big question is, how do you actually build it? It sounds daunting, but it's simpler than you think. The number one rule is to pay yourself first. Before you pay any bills, before you buy groceries, before you even think about that morning coffee, set a portion of your income aside for your emergency fund. Don't wait until the end of the month to see what's left over, because often there's nothing. The best way to make this happen is to automate it. Set up an automatic transfer from your checking account to your savings account right after you get paid. It could be $50, $100, whatever you can afford. The amount isn't as important as the consistency. By making it automatic, you remove the temptation to spend it. You won't even miss the money because it's out of sight, out of mind, quietly building your financial safety net in the background. If your income is irregular, just make it a habit to manually transfer a percentage every time you get paid. Start small if you have to. Even $20 a week is over $1,000 in a year. The key is to start now and stay consistent. Don't get discouraged if it feels slow at first. Every single dollar you save is a step towards financial freedom and peace of mind. Now, where should you keep this emergency fund? This is a crucial detail that many people get wrong. The goal here is safety and accessibility. You need to be able to get your hands on this money quickly when an emergency strikes, without any penalties or delays. So, the best place for your emergency fund is a high-yield savings account. It's separate from your everyday checking account, which helps you avoid accidentally spending it. A high-yield savings account is perfect because it's completely safe, your money is insured, and it earns a little bit more interest than a traditional savings account. What you absolutely should not do is invest your emergency fund in the stock market, cryptocurrency, or any other volatile asset. Yes, you might get higher returns, but you also risk losing a huge chunk of your money right when you need it most. Imagine your car breaks down the same week the stock market crashes. your $5,000 emergency fund could suddenly be worth only $3,000, and you'd be in serious trouble. The purpose of an emergency fund is not to make you rich, it's to protect you when things go wrong. So, keep it boring, keep it safe, and keep it liquid. A separate high-yield savings account is your best bet. Don't overcomplicate it. Let's talk about some common mistakes people make with their emergency funds so you can avoid these pitfalls. The biggest mistake by far is using the fund for non-emergencies. That new phone isn't an emergency. A holiday sale isn't an emergency. A weekend trip isn't an emergency. Dipping into your fund for these things completely defeats its purpose and leaves you vulnerable when a real crisis hits. You have to be disciplined. Define what an emergency is for you, like a job loss, a medical issue, or an urgent home repair, and stick to it. Another huge mistake, as we just discussed, is investing the money in risky assets. Remember, this is your insurance policy, not a lottery ticket. Keep it in a safe, easily accessible savings account. Finally, the third major mistake is waiting for the perfect time to start. People say, "I'll start saving when I get a raise," or "I'll start after I pay off this debt." The truth is, there is no perfect time. Life will always throw expenses your way. The perfect time to start is right now, with whatever amount you can afford, no matter how small. Procrastination is the enemy of financial security. Don't wait for a crisis to force you into action. Start building your defense today. To really drive this home, let's look at some real-life scenarios where an emergency fund is a total game changer. Imagine you wake up one morning with a severe toothache. You go to the dentist and find out you need an emergency root canal, and it's going to cost $2,000. Without an emergency fund, you're probably putting that on a high-interest credit card, adding financial stress to your physical pain. But with an emergency fund, you can just pay for it. It's still an unpleasant experience, but it's not a financial catastrophe. Or consider this. Your company announces unexpected layoffs and you lose your job. Panic sets in. How will you pay your rent? How will you buy groceries? If you have no savings, you're forced to take the first job offer that comes along, even if it's a bad fit or pays less. But with a 3 to 6 month emergency fund, you have breathing room. You have time to search for the right job without desperation. You can pay your bills, maintain your stability, and make a clear-headed decision about your career. That fund buys you time and options. And what about home repairs? Your water heater suddenly bursts, flooding your basement. The cleanup and replacement will cost thousands. Without an emergency fund, you might have to take out a loan or drain your retirement savings, both of which have long-term negative consequences. With an emergency fund, it's a hassle for sure, but it's a manageable problem. You can call the plumber, get it fixed, and move on with your life without spiraling into debt. These aren't far-fetched stories, they are the realities of life. An emergency fund transforms these potential disasters into mere inconveniences. So, let's bring it all together. An emergency fund is not just a pile of money sitting in an account, it's peace of mind. It's a buffer between you and the chaos of the world. It's the freedom to make choices based on what's best for you, not out of desperation. In today's uncertain world, with rising costs and economic instability, having this financial safety net is more critical than ever. It's what allows you to sleep at night, knowing that if something goes wrong, you are prepared. You don't have to be rich to be financially secure, you just need to be prepared. It all starts with that first dollar saved. Okay, so we've covered what an emergency fund is, why it's so crucial right now, and the real-life dangers of not having one. Now, let's talk numbers. How much do you actually need in that fund? This is a question I get all the time, and the answer can feel a bit intimidating, but it doesn't have to be. Let's break it down into manageable steps. Your first goal, your starting line, should be to save between $500 to $1,000. Think of this as your mini emergency fund. This amount is designed to cover those smaller but still stressful unexpected costs. A flat tire, an urgent dental visit, a broken appliance. This initial fund prevents these minor bumps from turning into major financial roadblocks that force you into debt. The key here is to get started. Don't get paralyzed by the big numbers. Just focus on hitting that first $1,000 milestone. It's achievable, and it will give you a huge confidence boost. Once you've hit that initial target, it's time to aim for the long-term goal. The standard advice, and it's good advice, is to have 3 to 6 months' worth of essential living expenses saved. What are essential expenses? This includes things you absolutely must pay for each month to survive. Your rent or mortgage, utilities like electricity and water, groceries, transportation costs to get to work, and any critical insurance premiums or debt payments. It does not include things like dining out, streaming subscriptions, or shopping for new clothes. To calculate this, sit down and track your spending for a month. Tally up only the absolute necessities. Let's say your essential expenses come out to $2,000 a month. Your long-term emergency fund goal would then be between $6,000 and $12,000. Now, I know that can sound like a huge number, but remember, this is a marathon, not a sprint. You build it up over time, piece by piece. Of course, this 3 to 6 month rule isn't one size fits all. You need to adjust it based on your personal situation. If you have a very stable job in a high-demand industry and a second income in your household, maybe 3 months is enough for you. On the other hand, if you're a freelancer with a fluctuating income, a single parent, or someone with chronic health issues, aiming for 6 months or even more provides a much stronger safety net. The more financial responsibilities and uncertainty you have, the larger your emergency fund should be. The goal is to have enough money to keep your life stable if your primary source of income disappears for a while. So how do you actually build this fund, especially when it feels like there's no extra money left at the end of the month? The single most effective strategy is to pay yourself first. This means that as soon as you get paid, the very first thing you do is transfer a set amount of money into your emergency savings. Don't wait to see what's left over after you've paid all your bills and done all your spending, because for most of us, there's usually nothing left. Saving first flips the script. It makes saving a priority, not an afterthought.